Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, now coming to you at Sunday at noon before the week starts with all the stocks to watch and the stock market news you need to see. And Nation, while AI stocks melt down and tech stocks get crushed, another group of stocks is quietly making money. These are businesses built on physical infrastructure, resources, and real world demand. The halo stocks that are seeing their stock prices jump 30, 40, and 60% higher. These AI proof stocks aren't disrupted by algorithms, and I'm going to show you 5 I'm buying right now. Stick around and I'll also share important news on shares of CrowdStrike Holdings, CRWD, Broadcom, AVGO, and an update to our stock market outlook. First, back to those halo stocks though, because the AI stock crash may just be getting started. The Global X AI and Tech ETF, the AIQ, is now down almost 5% from November, with bellwether Nvidia down more than 10%, even on a blowout earnings report last week. And groups within tech are getting slammed, with the iShares Tech Software Fund, ticker IGV, losing almost a third of its value. First, it was when AI powerhouse Anthropic released coding tools that investors feared would wipe out software companies. That sent stocks like Salesforce, ticker CRM, ServiceNow, NOW, and AppLovin, ticker APP, down 30 to 40% just this year. Then another company, and I shit you not, you cannot make this stuff up, a company that until just last year developed in-car karaoke systems, announced its new AI agent that could scale freight volumes by up to 400%, disrupting logistics and sending those stocks down as much as 30% on that news. Nation, this has gotten so bad that a thought experiment, a work of fiction disguised as analysis, drove a $600 billion loss in stocks on the 23rd of February. That's when Citrini Research released its scenario, and I hate to even call it analysis, but if you read through this, it's nothing more than just a what if monologue on how AI might affect jobs and the economy. This paper wasn't even meant to be a real grounded analysis of the trend, but just a thinking out loud of the worst case scenario, and that was enough to crush tech stocks again. Now, I'm going to highlight why this is one of your best buy the dip opportunities in tech later in our stock market outlook and the hardest hit stocks that I'm buying. But this kind of stock market madness has a tendency to build on itself. That means it's probably not over and you need to be ready for it. And that means looking for the new opportunities. And I found a group that is not only immune to that AI sell off, but is up double digits already this year. The Halo stocks, an acronym for heavy assets, low obsolescence, are seeing investors jump into those companies to create a low stress portfolio in this AI crash. That's because these companies are built on physical infrastructure, resources, and real world services. Think railroads, consumer staples, and retail goods. Their competitive landscape isn't in lines of codes, it's in equipment, supply chains, and an IRL business model. And that's meant while the market flatlines this year and tech plunges, stocks in these sectors like materials, consumer staples, and industrial companies are up double digits already, with some up 30 and 60% in less than 2 months. So if you just look at the best performing sectors so far this year, energy with its 23% return is really just a function of Venezuela and Iran, so it doesn't really apply to this theme, but then stocks in the material sector, those producing and processing the raw inputs like chemicals, metals, and construction materials, shares there are up over 16%. Then there's companies in the consumer staples that make those personal products, the packaged foods, and the things we all buy in any economy. Those stocks are up almost 15% this year. So as we all bunker down and wait for the rebound in those AI stocks, I want to give you the 5 stocks in this halo trade that not just going to smooth out the market craziness in your portfolio, but could also add to the upside. And those of you out there in the nation know I like to start with this big picture here at the sector level to see which groups are outperforming and which stocks I want to research. I'll use the State Street Sector Tracker here, which shows sector returns over different periods, and you can click through to each of these to find the stocks in that group in the S&P 500 index in each sector. Within materials here, you'll find the raw input companies like Freeport-McMoRan, Albemarle, and Newmont. In consumer staples, it's the packaged food, processing, and personal products from companies like Hershey's, Clorox, and Colgate. Then here in industrials, it's the heavy machinery and the transportation giants like FedEx, GE Vernova, and Deere. Now understand, this doesn't mean simply chasing the best performing stocks in the market. It's more about getting an idea of what types of companies are doing best in this halo trend, and then where you should look further. Within that theme, I like shares of Anheuser-Busch InBev, ticker BUD, which even though is already up 38% in the last year, is coming off a multi-year period of weakness, so could have still some upside left. The beer and beverage company is a powerhouse with 21 brands at over $1 billion in revenue each year, and the market leader in 28 markets, including 8 of the top 10 beer brands. The company is expected to post 7% revenue growth this year to $63 billion, leveraging that up to 17% in earnings growth to $4.37 per share. Now that puts the stock at 18.6 times on a price to earnings basis, which even after that recent run up is still below the 20 plus multiple it's traded at over the last year. Now this and a lot of these other halo stocks are not get rich quick stocks, but compared to the AI stocks losing 20 and 30%, that further upside of 10 or 20% positive return is going to be something to watch. I've been recommending Walmart, ticker WMT, for the last year, but was worried going into its most recent earnings report. Now, the stock is down about 4% since that mid February report, and once again, a good investment here, heading into what should be a better earnings report next May. I continue to argue that Walmart has several levers it can pull to that higher revenue and earnings growth, including the Vizio acquisition, which is supercharging its advertising segment. It's also soon to get a bump from the ChatGPT rollout of its shopping feature, and last year's tariff backdowns on food should help hold up profitability for the retailer. Now, shares aren't cheap here, even after that recent correction, and well above where I started recommending last year, with the price at 43 times on a PE basis. With about 5% annual revenue growth and almost 12% earnings growth a year, absolutely no risk that AI is going to stop us from those dirt cheap prices, Walmart is going to be able to churn out those steady returns. McDonald's Corporation, ticker MCD, flatlined last year, but has overall been one of the most consistent stocks in the market, up 65% over the last 5 years, and jumping 11% so far just this year. In fact, shares of Mickey D's have churned out a reliable 13.8% annual return over the last decade. That's on top of a 2.2% dividend yield, a total return of over 16% a year, and even edging out the 14% annualized return on the S&P 500 market index over that period. Now, this is another mature industry with just 5 to 6% annual revenue growth, but the company has managed to leverage that up to 8% earnings growth a year. The stock is up around its average long-term valuation of around 25 times price to earnings, so not cheap but not expensive. But no amount of artificial intelligence in the world is going to keep us from stuffing our faces with those cheeseburgers. Elsewhere in this Halo theme, I'd also be looking at LyondellBasell, ticker LYB, and Ecolab, ticker ECL, in the materials sector, as well as Deere, ticker DE, and Lockheed Martin, LMT, in the industrials. I'm going to show you the stocks I'm watching this week next, but if you haven't yet, join me on the Blossom Investing app with a special invite link I'll leave in the description below. It's totally free to download, and besides seeing those stocks that I'm buying in real time, you're also going to see what over 500,000 investors are talking about in the social feed. So look for that link or just scan the QR code here. Looking at the stocks I'm watching this week, CrowdStrike Holdings, ticker CRWD, begins another week of earnings on Tuesday with its shares down more than 20% this year on that AI-driven sell-off in cybersecurity. That sell-off started when Anthropic released an add-on that could look for security risks in code, but like the bigger trend, this isn't the kind of one-stop product that is going to replace the service, the expertise that companies need from a cybersecurity provider like CrowdStrike. This company is the industry leader with its Falcon platform, expected to post 20% plus growth in revenue this year and next to $5.8 billion. Now, Zscaler, ticker ZS, plunged when its earnings, while beating expectations, didn't just wow the market last week, but these two stocks continue to be my favorites in the space, along with Palo Alto Networks, PANW, and Fortinet, FTNT. Now, these aren't must-buy cheap territory, but instead of trying to time that rebound, I just put them a little bit more in each month, put them on a monthly buy list, and hold long term. Broadcom, ticker AVGO, reports its earnings on Wednesday, with the stock down 8% this year after a huge 60% run higher last year. Folks, beyond maybe Nvidia, there is no other company with as much to benefit from that data center infrastructure buildout, and you see it in the growth here. Broadcom, with its networking hardware, accelerators, and chips, is expected to post 52% sales growth this year to $97 billion. But more interesting here is that it's also expected to report 51% earnings growth to $10.32 per share. That means versus others in the space, like Supermicro Computers and AMD, where those profit margins are under threat from competition, Broadcom is able to use its competitive advantages to protect its own profitability and grow earnings just as fast as it's growing revenue. Looking back here, I called out Broadcom as the next $1 trillion stock last year on April 9th when it was just $146 a share, pointing out its strength in that data center buildout. Up 117% in less than a year since. I'm holding on as we see that theme play out, and this one gets to a $2 trillion market cap. And Marvell Technology, ticker MRVL, follows with its earnings on Thursday, and this stock down 7% over the year. The company is a direct competitor with Broadcom in its accelerator chips, and while I don't think it has quite the advantages that AVGO has in tech, but that value is hard to beat here. That's because this company is reporting 41% revenue growth to over $8 billion and leveraging that to 80% growth in earnings to $2.83 a share. And it's only trading for a price of 8.4 times on a price to sales basis. That is nearly half as expensive as the 15 times price to sales valuation that investors are paying for those other shares of Broadcom. So with Marvell, you're getting a company deep into that AI build-out theme, growing at 40% plus and trading relatively cheaply against competitors. Updating our stock market outlook with last Friday's Producer Price Index, that's the PPI measure of inflation, coming in hot at 3.4% over the last year. We've now seen 3 consecutive inflation reports. That's the CPI, the PPI, and the PCE that have been all higher than expected. It looks like inflation pressures are stubbornly reigniting around 3% and well above the Fed's target of 2% to continue lowering rates. That has already pulled down the market expectations for a Fed rate cut at the March 18th meeting to just 4%. That's down from odds as high as 16% of another rate cut just a month ago. That higher inflation and an unemployment rate still under 4.5% is putting further market supporting rate cuts in jeopardy. Investors now expect the next rate cut not until July and then just one more in October of this year, according to the CME FedWatch rate tool. And nation, remember, that's important because those interest rate cuts bring down the cost of money for businesses and consumers and also play a role in stock values as well. With your tech and your growth stocks, most of the return is based on those future cash flows. And those cash flows are discounted using an interest rate to find the fair value of the stock now. Higher rates then, or just fewer rate cuts, means that lower fair value for growth stocks, which is a big reason for the weakness in tech stocks over the past month. We will see part of the Fed's decision with the monthly jobs report on Friday, expected to show just 54,000 jobs created in February. It would be less than half the surprisingly high gain of 130,000 jobs created in January, but most are expecting that number to be revised lower as well. Bigger than that near term picture, though, the 3 to 6 month direction from those rates and inflation and the economy is the bigger picture and the opportunity for returns over the next few years. That recent sell off in AI related stocks, especially software, has reached just ludicrous speeds, and rational investors are going to make a lot of money from it. Nation, understand the market loves drama and it's going to latch on to any story, no matter how far fetched, as an excuse to either boom stocks higher or to crash them lower. Last October, it was the scare that AI couldn't possibly live up to the hype and that the promised spending that was taking stocks higher just wouldn't materialize. In just 1 month, $2.4 trillion in value was wiped out, sending the NASDAQ Tech Index down almost 6% and crashing those AI related names. In a complete 180, the new fear is that AI is going to be so life changing that it's going to take over all jobs, and that has sent stocks in software, logistics, and cybersecurity companies down double digits this year. But if you just step back, take a minute, and analyze this, if AI is going to be so powerful that companies are going to replace people with programs, then those $1 trillion in AI spending is going to be there over the next several years. That should mean we see a renewed boom in those infrastructure stocks, like the chip makers like Nvidia and Broadcom, the server leaders like SMCI, and the cloud providers like Amazon and Oracle. But these stocks are still in the gutter, with only SMCI up so far this year. Folks, the fact is, nobody knows where this is going. AI will change the world, but it's not going to be overnight. Case in point, Amazon Web Services, the cloud segment of Amazon, suffered multi-region outages on 2 separate occasions last December when AI agent tools took down the service. In one of those, the AI agent actually decided that the solution to a relatively small problem was just to delete the entire environment and start over from scratch. I don't know about you, but that does not sound like the kind of thing that companies are going to rush to implement, letting those kinds of AI agents just take control of the company. Another point here is we've had access to free open source software since before the 90s, and people were saying that it would then destroy the software industry as well. Open source applications like Linux created millions of applications, but It didn't put a dent in the industry because companies wanted that deeper services around software, the tech support, the upgrades, the community of experts within that software company. And that software industry is now 5 times larger than it was back then. Now, my point here is, and I've got two very important lessons for investors, but first, understand that in today's advertising driven online world, financial media is going to push any story that gets clicks. You need to be able to look past the fear mongering and the FUD and to see the truth. The second, and more importantly, do not panic and sell out of those tech stocks hardest hit over the last few months. Now, a part of your portfolio in stocks in that Halo group and across the broader market, with maybe an ETF like the Vanguard VOO, it's always a smart decision. But those AI related infrastructure and software and security stocks, those are in solid buy the dip territory right now. In fact, we listed out your 9 best stocks in our stock draft video last week, a giant collab with 4 other investing channels. It's MarketBeat, Tom Nash, FinTech, and Mark Rusin. I'm going to link to in the description below, so make sure you check that out. Nation, it might not feel like it when the market slumps sideways and the biggest tech names get crushed over the last 6 months, but this is the opportunity investors always say they want, that dip in stocks before a renewed upside that turns into returns. Look past this near term noise and keep loading up on the stocks that are going to ride that AI era higher. Join me on the Blossom Social app with the special invite link in the description below and see what over 500,000 investors are talking about. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.